2 rate hikes. I did the math. It's a lie. 2 rate hikes. That's what the forecasters are predicting. And that's what the hawks are screaming about. That's what the headlines are telling you to panic about. But I did the math. It's a lie. Not a mistake, not a difference of opinion, a lie. Let me show you. If you're new here, I'm Greg Williamson. I have over 30 years in the mortgage business. This channel exists because I believe mortgages should be managed, just like investment portfolios are managed, not guessed, and definitely not panicked about, because some forecaster who's been wrong for years told you to lock in. Every week, I cut through the noise and I give you a clear strategy, not a hedge, an actual call. This week, both central banks spoke. The Bank of Canada held, and the Fed held. And what they actually said tells you everything you need to know if you bother to read it. Let's break it down. The Bank of Canada held at 2.25%. That's 4 times that they've held. They've been here since October 2025. No surprise. But here's what Governor Macklem actually said. The words nobody's reading. First, he said the Governing Council agreed to look through the war's immediate impact on inflation. We've talked about this a few times in the previous episodes. Look through. That means they're not reading or reacting to the oil spike. They're treating it as temporary. Second, he said, and I'm quoting directly, if the economy evolves broadly in line with the base case, changes in the policy rate can be expected to be small. Small. Not 2 hikes, not consecutive increases, small. Third, and this is the big one, he said if the United States imposes significant trade restrictions on Canada, we may need to cut the policy rate further to support economic growth. Cut, not hike. Cut. The only scenario where Macklem mentioned hiking rates was if oil prices stay elevated and start feeding through to broader inflation. And he specifically said, again, his words, so far, there is little evidence that higher oil prices have fed through to other goods and services prices more broadly. That's to be expected. It takes time. So far, no evidence though. So where are 2 hikes coming from? Because it's not from Macklem. Now, let's look at the Fed. They held as well. Powell said, economic activity is expanding at a solid pace. But, and this matters, job gains have remained low on average. Low job gains. That's not an economy that needs higher rates. He acknowledged inflation is elevated, partly because of energy prices, but the Fed's stance is clear. They're watching, they're holding, they're not hiking. And remember what we talked about last week. Kevin Warsh is coming in as the new Fed chair. He's looking at trimmed mean PCE, which is already at 2.33%, basically at target. The Fed is setting up for cuts, not hikes. Maybe not tomorrow, but the direction seems clear. Now, could things change? Of course. If oil stays elevated, say over $100 for years, and feeds into wages and broader prices, the Bank of Canada might have to act more aggressively. But even then, even in the worst case scenario of stagflation, history tells us that central bankers are more likely to tolerate a little more inflation than crush the economy with aggressive hikes. They learned that lesson in the 1970s. They'll hold or they'll move slowly. That's why variable with an active mortgage management is still the play, even in the worst case scenario of stagflation. You're positioned to adapt, not locked into a bet you can't change. Now, let's talk about why the OIS market and the hawks in Canada are predicting 2 hikes and why they're wrong. Here's the math they're ignoring. The Fed's fund rate is 3.5%. The Bank of Canada policy rate is 2.25%. That's a spread of 125 basis points, and the US is already significantly higher than Canada. If Canada hikes while the US holds or cuts, what happens? The Canadian dollar strengthens. A stronger loonie makes our exports more expensive. It hurts our trade competitiveness, and our economy is already too weak for that. Macklem said unemployment is running 6.5% to 7%, with weak hiring and fewer job seekers. You don't hike into a weak labor market. You don't hike when your currency is about to strengthen against your biggest trading partner, And you definitely don't hike when your own central bank governor just said changes will be small. And they might need to cut if the US squeezes us on trade. 2 hikes? Show me how. The only way Canada hikes is if the US hikes first. And the US isn't hiking, they're holding. And Warsh is coming in dovish. 2 hikes in Canada is not a forecast, it's a fantasy. The OIS traders and economists need to bring the US situation into their analysis, and they're not doing that. And here's what makes me angry. These forecasts, these predictions of rate hikes, they get printed in headlines. Regular people read them, they panic, they call their bank, and some banker who read the same headlines tells them, you better lock into a fixed rate because rates are going up. And they lose big. This is the same consensus that told you inflation was transitory in 2021. They were wrong for months, turns into years, and it cost Canadians thousands, sometimes tens of thousands of dollars on their mortgage. The City Inflation Surprise Index was off the charts. The forecasters were hopelessly behind. And now, the same forecasters are telling you 2 hikes are coming. Based on what? Not on what Macklem said, not on what the Fed said, not on pure economic math, not in reality. They're guessing or they're hedging, and they're usually wrong. But people listen because it's in the headlines, because their banker said so, because some hawk on TV sounded confident. And then they lock into a higher rate than they needed to, and they pay for it for years. That's why I do this show. That's why I'm calling it out, because someone has to. All right, let's do what the forecasters won't do. Let's actually run the numbers. Right now, an insured fixed 5-year rate's around 4.39%. Insured variable rates are around 3.65%. That's a spread of 74 basis points, almost 3/4%. On a $400,000 mortgage with a 25-year amortization, here's what that looks like. At 4.39% fixed, your monthly payment is about $2,195. At a 3.65% variable, your monthly payment is about $2,037. That's $158 per month, almost $1,900 per year. Over a 5-year term, that's nearly $10,000 in savings if rates don't move at all. But the hawks say rates are going up. Fine, let's stress test it. The 3-hike cushion. Each 25 basis point hike adds roughly $50 to $55 per month to your payment on that $400,000 mortgage. Let's say the Bank of Canada hikes 3 times over the next 18 months or longer. 3 hikes, 75 basis points. I don't know, but let's say it does. Your variable rate goes from 3.65 to 4.4. At 4.4, your payment is now about $2,200, basically the same as the fixed rate you could have locked into 2 years earlier. So even with 3 hikes, which again, I'm saying are very unlikely to happen, you break even. But here's what most people miss. If you take the variable at 3.65, but you set your payments at the fixed rate of $2,195, which presumably you can afford because you're considering a 5-year fix anyway, you're paying an extra $158 per month toward the principal from day one. That's $1,900 per year going straight to paying down your mortgage faster. So by the time those hypothetical 3 hikes happen, you've already paid down an extra maybe $2,000 to $3,000 in principal compared to that fixed borrower who just locked in. You're not behind, you're ahead, even if the hawks are right. And I don't think the hawks are right, but with this strategy, you are mitigating the potential downside risk of the variables rising. Here's how you actually play this. Step 1, take the variable rate right now, 3.65%, is significantly cheaper than the 4.39 fixed. Step 2, set your payments as if you were at a fixed rate. Pay the $2,195 instead of $2,037. That'll automatically reduce your long-term amortization. This builds your cushion and accelerates your paydown. Step 3, we watch the market for you. We give you a monthly report analyzing where your rate is relative to the market. We make a call. We tell you when and if it's time to lock in. No guessing, no waiting around, no you have to try to figure this out yourself. We do it for you. Step 4, if yields fall, which they should if the US cuts rates and manages the long end, we lock you into a fixed rate that's better than what you can get today. So when fixed rates go below 4.39, closer to 3.6, 3.7, then you win. twice. This is not about guessing right once. It's about being positioned to adapt. That's what managed mortgages means. One more thing about fixed rates. The 10-year yield in the US just crested 4.5%, the exact zone that Trump always intervenes in. Why? He has no choice. The US cannot have yields approaching 5%. The debt spiral unravels and it's violent. Just ask the UK, where this week long yield just surpassed 5% and their bond market is unraveling. The US will not let that happen. So they will manage yields or they will press even harder to end the conflict in the Middle East, as this will most certainly bring yields down. Now, if you're at a bank with a variable rate, you might be thinking, I can lock into fixed anytime with no penalty. That's true, but here's what they don't tell you. When you go to lock in at your bank, they know they have you captive. They know you have a penalty of, say, $5,000 or $6,000 if you want to leave and go somewhere else. So why would they offer you the best rate? They won't. They have leverage. You're stuck. With us, it works differently. We'll move you to a lender offering a better fixed rate and we split the penalty with you. So it might cost you just $3,000 to lock in, but you could save $12,000 compared to the crappy rate your bank would offer on your early renewal. That's the math. That's why this matters. That's why where you get your variable matters just as much as whether you get a variable. So let me give you the call based on where you are. If you're looking to buy right now, variable's the play. The spread is 74 basis points. That's a 3-hike cushion. The Bank of Canada isn't hiking. Macklem basically told you that. The Fed is holding, and the next chair is dovish. Take the savings. Set your payments at the fixed rate. Build your cushion for downside risk. If you already have a fixed rate over 5%, get out. We can often structure a relock right now or switch to variable and you pay no penalty, zero. Don't sit in an expensive mortgage when rates are coming down, not up. This is a window. Take it. Now, for that type of mortgage, it has to be an insurable mortgage, meaning that your property value is under $1 million or you had an insured mortgage before. Now, if you already have a variable rate, you hold. You're exactly where you want to be. The path of least resistance is down or even flat. Don't let headlines scare you into locking in at the wrong time. If you're coming up for renewal, this is probably the time for you to go variable. The spread is wide. The math works. But let's look at your specific situation together. 2 rate hikes? Nah, I did the math. It's a lie. The Bank of Canada said changes will be small. They said they'd cut if the US squeezes us in the upcoming trade agreement renewal, and who doesn't think Trump's going to lay the boots to us? They said there's no evidence oil is feeding into broader inflation yet. The Fed is holding. Warsh is coming in dovish. The US isn't hiking. Canada cannot hike if the US doesn't. The currency math just doesn't work. The labor market math doesn't work. None of it works. And even if I'm wrong, even if they do hike 3 times, you still break even if you follow the plan. Take variable, set the payments at fixed, build your cushion. We watch and we tell you when to lock. Don't listen to the forecasters. They were wrong about inflation. They were wrong about transitory. They'll be wrong about this too. Listen to what the central bankers actually said. Do the math and position yourself to win. If you want to help figure out your next move, click the link in the description or the pinned comment below to book a call. See you next week.